Good afternoon. My clock shows that it is now noon. This is the third webinar in our series, which is part of a new online farm management training course. We developed this course as part of a grant from the Farm Service Agency. Today's speaker is Dr. Darrell Peel, a professor here in the Department of Agricultural Economics at Oklahoma State University. If you have any questions, please use the chat box in the lower right corner to submit them. Dr. Peel will answer any questions at the end of the presentation. Now, I will hand it over to Dr. Peel.
All righty. Thank you, Brent. Good afternoon, everyone. Appreciate you joining us for this session today. I'm going to take a little bit of time and go over some of the cattle market situation, kind of bring you up to date on sort of where we are and look ahead a little bit to what we're expecting for the rest of the year and maybe even a little bit beyond that. So we'll get into this. We're going to talk mostly about these cattle market fundamentals, so we'll talk about the supply side in terms of where we are with inventory and beef production. We'll talk about the demand side a little bit and bring in a little bit on the other meats, at least briefly. We'll talk a little bit about international trade and just a little bit about feed and forage markets and conditions. Before we do that, I think there's a backdrop here, and I suspect in some of your other sessions you're hearing some of this, so I won't spend much time on it, but I think it's very important from a cattle market perspective to be keenly aware of this global and macroeconomic environment that we're in. And I say that because we've had a lot of issues the last few years, a lot of volatility. I think arguably we could expect to see perhaps even more volatility, certainly a continuation of that volatility as we go forward. And that's going to be important from a cattle market perspective because I think I'm going to suggest to you that there's reasons to think that within the cattle industry, internally in those cattle market fundamentals, there's reasons to expect a little more stability than we've had over the last 4+ years. But that said, I think the greatest potential for volatility in general in the marketplace that would affect cattle markets and certainly the most likely place for some shocks comes from this external environment. So I'm not going to spend much time talking about it. We could spend a lot of time talking about it, but we know that we've got a U.S. economy that, by some measures, is pretty strong. The stock market has been strong. The unemployment rate has been low. We are in an environment where we're expecting interest rates to go up. We've got a strong dollar, and I will talk a little bit about that and the direct impacts on cattle markets and meat trade. But again, there's a lot of volatility. We're undergoing a lot of political change right now, unknown policy changes. Part of it's just the uncertainty of what's going to happen as well as the potential impacts of whatever does happen. And so I think that's the environment we're in. There's still a fair amount of uncertainty from a global market perspective in terms of, the kinds of things that we saw over the last few months, the Brexit vote last summer, for example, in Europe, and those kinds of things. So there's that backdrop. And again, I think from a cattle market perspective, that's probably the most likely place that we could see the kinds of shocks that would, directly impact this market as we go forward. That said, let's get into these cattle market fundamentals. Here's a price chart that shows you this is Oklahoma calf prices and feeder cattle prices, and then a 5-market fed cattle price. And obviously you can see over the last 4 years we've been through lots of unprecedented things in terms of going up to record levels, to levels that we knew were not sustainable, but we didn't know how it was going to play out. The backside of it has been very dramatic over the last 2 years in terms of prices coming down from those record levels. Faster, frankly, than anybody expected, and somewhat more dramatically. And if you kind of look over to the right-hand side, during this time period of 2016 was really an important transition year. We were trying to find a bottom coming off of that top. We actually had a very severe bottom in October that you can sort of see here, especially with these calf prices. And then following that through the rest of the fourth quarter, and so far this year, we've had a nice recovery from those fall lows. We've got some strength back in these markets. We've got prices, basically back to where they were prior to 2013, which were not bad levels by historical standards, and in general, they're not that bad levels. And again, my message here is that everything that happened from about mid-2013 through middle 2016 was, and much of that was driven by internal factors, but that's past us now. I really do think we're beyond that, and I think from this point on, we'll talk a little bit more about price expectations as we wrap this up, but I think there's reason to think that we're kind of back to a little more stable environment. And even though I can't tell you exactly what it means, but I'm going to describe it as a business as usual kind of an environment in the cattle industry. We've realigned some margins. We've got multiple levels here, lots of issues that were out of line, and that caused a lot of the dramatic things that happened through the highs and lows of the last few years. Most of those margins have kind of realigned, and there's reasons to expect that we can be a little more stable going forward. Wholesale beef prices, just to show you, have adjusted down just like cattle prices have, not as much, and they're still in the process of adjusting. But again, we've had some real strength, especially in the last 2 or 3 weeks, and some that's not even reflected on this chart. Stronger than expected beef markets this spring. We'll talk about that in the context of other meats a little bit later. But again, reason to believe that despite the adjustments we've been through, there really is some fundamental strength in these markets. Retail beef prices also peaked in 2015 and are working their way down. They haven't come down nearly as much, certainly in percentage terms, as cattle prices have. And they won't go as far, and B, they take a lot longer to do it. And so as we go forward, we're going to continue to see these retail prices adjust. They're always kind of playing catch up to whatever's going on in the live cattle market. The supply issues drive those changes, and we see them happen very quickly, and then it takes a while for that to be reflected at the retail market. So it's an ongoing process, and I'm going to argue with you that cattle prices are kind of in a sideways kind of a pattern for 2017. That said, I do expect to continue to see these retail prices weaken because they're really catching up from the past several months to a year, and so they will continue to adjust even if cattle prices really don't necessarily have much of a trend to them this year. So that said, that's kind of sort of where we are right now. Let's go back and look at the numbers a little bit. January 1, we confirmed that we are still in herd expansion. Well, in 2016 was the third year of herd expansion. All cattle and calves were up 1.8%. Beef cows were up a strong 3.5%. We'll look at a graph that puts this in perspective in just a minute. Beef replacement heifers, of course, is our best indication out of these numbers of what we expect in 2017. It was up again, and certainly would suggest, and in combination with some other factors, that we would expect 2017 to be a continuation of this herd expansion. Probably not as strong as we've seen the last 2 years, but I think a significant level. And then the real question is sort of what happens after that. We'll get to that in just a second. Feeder supplies are bigger. We started herd expansion in 2014, so by 2016 and going into 2017, we've got more feeder cattle out there that are coming through the system. And that's going to be true. Herd expansion in 2016 means a bigger calf crop in 2017. It means more feeder cattle out through 2018. So we know that through that time period, and if we see more expansion in 2017, then we're going to continue to see increased cattle numbers and beef production. Probably at this point, we can pretty safely say we're going to see increased production through 2019 at this point. So, that's kind of where we are. Oklahoma's situation is similar, a little bit different, a little more exaggerated in some cases. All cattle and calves were 5 million head, up 4%. Our beef cow herd was up a strong 8.9%, and I'll talk about that in just a second in terms of put it in relative context. Our beef replacement heifers were off a little bit. We've expanded faster than some places in the rest of the country, and there may be some indication that Oklahoma is not likely to see quite as much herd expansion in 2017 as perhaps the national average will be, although that remains to be seen. But there's a logical reason to think maybe Oklahoma got there a little quicker than some other places, and that we won't see as much herd expansion. But in general, our numbers are up. Our cattle on feed numbers are rebuilding from lows the last couple of years. This looks like a huge increase, 10.7%. It's really just kind of getting us back to normal levels following the drawdown that we had during the drought years. And so that's a long-term rebuilding process. So if we look at a chart here, there's two scales. The blue line is, the red line first is the national numbers measured on the right-hand scale. These are in thousands a head. And so you can see the bottom in 2014, we expanded into 2015, into 2016, and then, through 2016 into 2017. And you can see that growth. Oklahoma has done very dramatic things. In 2010, which was the year before the drought really started, we were at the highest herd levels in Oklahoma since 1984. And we had, in fact, been trending up for several years while the rest of the country was trending down, going all the way back to the late 1990s. And so we were at that level. Of course, the drought had dramatic impacts. And so by 2013, we had dropped to the lowest state beef cow herd since 1962. You can't even find it on this graph. It would be somewhere to the left of this graph the last time we were that low. Dramatic drawdown in 2 or 3 years there during the drought. And then in the 4 years since 2013, we have gone back above the 2010 levels, once again to the largest beef cow herd in the state since 1984 at just under 2.1 million beef cows. We've added just almost 24% to the beef cow herd in Oklahoma in 4 years' time. So that's probably among major beef cow states the strongest response, but it's part of the issue in terms of why we've seen some of the price adjustments that we've seen. Oklahoma responded very dramatically to the price signals of 2014 and 2015 to expand the cow herd, and certainly we've done that in a very dramatic fashion. So if you look at this chart, it shows the percent change in the beef cow herd, and the reason for looking at this, if you look at what we've done the last 3 years here, we've had herd growth, we had strong growth the last 2 years, but it's not really different than what you see going back to the early 1990s, which was 20 plus years ago was the last time we had a full-blown herd expansion. It's a similar kind of a response. In general, we got smaller than we ever intended to, so we've grown pretty aggressively, certainly in the last 2 years. And again, my expectation is that will continue. Here's one more last look at the data in a different way. This green line here shows the low in 2014, so year zero of a new cattle cycle, if you measure it from low to low. We expanded in 2014, 15, 16. And then, at this point, what do we expect for 2017? We'll be monitoring slaughter rates for heifers and cows and other things to try to get an indication as we go through the year. But given the replacement numbers that are out there, the beef replacement heifers, I expect that we'll add another 1.5% to 2% to the herd, which will put us up pretty close to this 32 million head level by the end of this year. And then after that, we have to wait and see. It depends on kind of what happens from here, but my general expectation is that we probably are about done with herd expansion at that point. We'll see it level off going into 2018 would be my expectation at this point. Some of it depends on things that we just don't know yet, because really what happens in response to this supply situation is going to depend on the demand side, and we'll get to that here in just a little bit. So you can see just quickly, the last 2 years, we had strong increases in replacement heifers that supported this herd expansion. I actually thought this number might be lower this year going into the report that we got at the end of January with the new data. Instead, it was up slightly, 1.3%, not up like it has been the last couple of years, but that tells me there's a big stock of heifers out there that are going to enter the herd. And so we very, very much likely will see a continued herd expansion here in 2017. Finally, the feeder supplies. This is the aftermath of that, of course, after expanding the herd. Really in 2016, we started to see the first significant increase in feeder supplies. And we'll talk about how those move through the system and turn into beef production here in just a minute. We're looking at continued increases in 2017. And again, given what we've said, we probably see this number increase in 2018 and 2019 as well at this point. And then beyond that, we have to kind of wait and see what happens with the herd expansion as we go forward. But the supply side is kind of set really now through certainly through 2018, and then depending on what we do this year, very likely through 2019 as well in terms of being in a growing supply scenario. This is the latest drought monitor map. It's March. It's still ahead of the growing season for the most part. We've been through a lot this last winter with drought conditions in the southeast, for example, that got better for a while. Now they're starting to expand again. In our country here in the southern plains and central plains and up into part of the Midwest, even through Missouri, these marginally dry conditions have expanded pretty significantly in the last couple of weeks. So we'll be watching it. None of this is really a major issue right now. 60 days from now, it will be a major issue. And so we certainly are watching it this time of the year to see what happens. Obviously, there have been some very important impacts with this in the southern plains with our winter wheat. It's been a tough winter. Dry conditions has limited growth, and that continues to be a bit of a challenge in some areas. And then, of course, more recently, the wildfires out west. In fact, just in the last couple of days, I've driven through some of the wildfires out in the panhandle of Oklahoma that extended well up into Kansas, and it's very dramatic, the devastation you see in those fire areas and the impacts that has to those producers, especially perhaps regionally. These are not the kind of things that are going to cause major impacts on cattle markets in general. And in fact, given the time of year that it's happening, if we have normal spring moisture, those rangelands will recover very quickly. And in fact, in some senses, may be improved by the fires as we get into the summer. But in the short run, we lost a lot of pasture, lost a lot of hay. And the numbers are still uncertain, but certainly several thousands of head of cattle, as well as at least one hog farm that was caught in the fires, and some hogs were killed in the fire as well. So, those are the kind of impacts we're seeing right now with that. Just a quick look at crop prices. And of course, our perspective here is more from a feed perspective, but obviously one of the challenges financially in agriculture right now is the fact that crop prices, as well as livestock prices in general, have been under a challenge. And so you've got both sides of both sectors really impacted. But we've got cheap feed across the board, cheap grain prices in general. We've got lots of wheat, we've got lots of corn, we've got lots of soybeans. Soybeans may see some increase in price this year. These are the most recent USDA projections for crop years 2016. But the bottom line is, from a feed standpoint, from a purely livestock standpoint, we're going to continue to see very favorable feed prices. That won't be a challenge for us like it is or has been certainly at some times in the past. Wheat prices are very low, and that has a lot of impacts in the southern plains on what we choose to do with those wheat acres. There is a lot of cattle, again, having just driven across most of western Oklahoma in the last couple of days. There certainly is a significant number of cattle grazing out wheat this year. We expected that. If we could get more cattle in a realistic way, I suspect there would be even more grazing. But the numbers and the prices kind of limited how many additional cattle you could come up with for graze out. But certainly there is some graze out happening, and I suspect that a significant number of these wheat acres will wind up being used for hay in some cases. In some other cases, it will be treated as a cover crop and actually be taken out pretty quickly here in favor of some sort of summer crop alternative. We hear a little bit about that in certain areas. So again, corn prices in the southern plains right now are running very close to year-ago levels. We don't see that changing really for the rest of this marketing year. Of course, as we get into a new crop season, then it could change going into the next crop harvest, but it really doesn't seem too likely at this point in time. So for the foreseeable future, crop prices are not most prominent on our radar screen of issues right now compared to some other things. In response to the herd expansion and the increased cattle numbers we've talked about, we've seen over the last few months increases in feedlot placements. Those cattle are out there, they're in the pipeline, they're going to come through the system, but we've seen simultaneously a very strong increase in marketings, which is this blue line down here. And what that means is that we're moving cattle through the system. That's a good thing, actually. And we're not necessarily seeing a big increase in cattle on feed numbers. Feedlot inventories have not grown. That's just a measure of the level at one point in time, and really what's important at the feedlot and what's important for markets is to handle these bigger supplies with goods throughput. Feedlots stay current, they market the cattle on a timely basis, and we've seen that for the last year, and that's helped us be in the position where we have today with the kind of strength we've had in fed cattle markets and really feeder cattle markets right now is a result of what happened over the last 12 months or so at the feedlot to really handle growing supplies in the best possible fashion. And so as long as we continue to see that and we don't get into a situation where feedlots try to start holding cattle and slowing them down and making them bigger, that's when we create problems, particularly in a growing supply scenario. So, we are seeing cattle slaughter up. It's up about 6% year over year at this point in the year. We don't expect it to be that high on a year-over-year basis. It grew last year, so as we get into the second half of the year-over-year increases should be smaller, but we're expecting cattle slaughter to be up. Again, there's more cattle out there, and they're coming through the system. So we're going to see a 3.5 to 4% increase in cattle slaughter. Carcass weights can offset part of that, and we're seeing that right now. Over the last year and a half, we've been through lots of ups and downs with carcass weights, but they've been more favorable so far this year. They're down year over year. So, so that increased cattle slaughter is translating into a smaller increase, but still an increase in beef production as we go forward. So as the cow herd expands, this is about the fourth time you've seen this data, but in a different way. The cow herd will continue to expand probably in 2017. Beef production, which dropped to a 20-plus year low in 2015, grew about 6%, actually 6.4% in 2016, and we're projecting another 3.5 to 4% increase in beef production here in 2017, which will put us back to levels that we were at in about 2011 or thereabouts, going into the drought, really. And then by next year, we're on path to see beef production perhaps rise to record levels. And so we'll continue to have this supply challenge, if you will, and that certainly raises questions and about what the impacts might be on the on prices and whether we've can maintain something close to where we are. And again, that's going to hinge a lot on the supply side as we go forward. Let's see here. Let me try to wrap this up fairly quickly. So on the total meat side, we're looking at about a 4% increase in beef production. We won't necessarily increase consumption that much. Hopefully exports will continue, or the trade, both imports and exports, will continue to modify that a bit. But one of the challenges we face is the fact that not only is beef up, pork will be up, poultry will be up. So we're looking at close to a 3% increase in total meat supplies. And again, in all cases, trade can be favorable and offset some of that. One of the challenges, and there's new news today, that there's some additional outbreaks of avian influenza. We had one case reported last week of high pathogenic avian influenza. Those have impacts because what happens immediately is that a number of international markets will close their doors to broiler exports. If we don't export that meat, it stays in the U.S. market, and that can weigh down on all the meat markets as we try to deal with that increased consumption. The news today, it's still very new. There are some more cases now in Alabama. Last week it was in Tennessee, and there was one isolated case up in Wisconsin. Alabama is a major broiler producing state. If there are bans on meat from broiler meat from Alabama internationally, then that has significant supply implications potentially here very quickly as we go forward. So that's kind of a breaking story as we're talking this morning. If you look at the ratio of beef prices to chicken prices, they went to record levels in 2014, 2015, and they've stayed pretty high. And so even though beef prices are adjusting down, so are broiler and pork prices, and the net effect is that beef has maintained a very strong ratio to retail chicken prices, which is a good sign in terms of indicating that demand is pretty strong. And again, those retail prices will continue to adjust, but the implication here is that that we can absorb that increased production we know is coming in the best possible fashion, with beef demand hanging in there pretty well as we go forward. There's two components to that: the domestic side and the international side. And so obviously we in beef, we both import and export significant amounts. Beef exports dropped in 2015 when we had record high prices and nearly record low, or at least 20-year lows in production. But they began to recover as expected in 2016 with lower prices and increased production. At this point, we project continued improvement in that in 2017 and 2018 with prices and production becoming more favorable. The strong dollar is a headwind to exports, but we're seeing these market adjustments despite that. As long as the dollar sort of maintains its relative strength, then it won't have that much impact. If it should get weaker, which is not likely in my opinion, that would actually favor exports, at least in the short run. Should it get stronger, that would be an additional headwind that could modify things. Obviously, there's lots of talk right now in terms of the political changes. Things like renegotiating NAFTA have potential to really impact these things. If you look at beef, pork, and poultry together in 2016, nearly 24% of our total meat exports from the U.S. went to Mexico in 2016. If you add in Canada, just on the export side, of all three of the meats, you're up to almost a third of our meat exports were involved in NAFTA countries. So this question of whether we're going to change NAFTA and what the implications of that might be is a fairly important one from the meat industry standpoint as we go forward. On the import side, exactly the opposite happened. When prices were high and production was low, we saw an increase in imports, and then in 2016 we started to see that adjusting back down. And there were some things going on. Australia had a drought, and they had some issues that favored them exporting more. At the same time, we were in a position to import more, so we saw big increases from Australia. That's gone the other way now. Australia is recovering from the drought, and their production is actually squeezed, and the market forces are pulling us down on these imports. So the exact opposite effect. After peaking in 2015, we saw a decrease in imports in 2016. We're projecting an additional increase in 2017 and 2018. Again, assuming that there's no major changes or major shocks in any of the political environments, either in the U.S. or anywhere else for that matter. Let's see, what do we got left? So, if you kind of take annual average prices, you can see what we've been through, you can see where we are, and then for 2017, 2018, we're projecting a more stable environment, more typical kinds of relationships between calf and feeder and fed cattle prices. Given the supply scenario we laid out, the idea that prices will probably generally weaken a bit more into 2018 and 2019 is pretty reasonable. But I think, again, as long as demand stays in there, and especially for 2017, where we find ourselves today, we're not expecting major changes. So if you look at the average annual or the average prices for the fourth quarter of last year, and we're actually a little bit above those so far in the early part of 2017, but take those as the last sort of known numbers here from a quarterly standpoint, and then you look at this range of what we're projecting for annual average prices in 2017, we see that we're projecting to be at or above those levels for calves, at about the same level for feeder cattle, perhaps a little bit above those for fed cattle, and certainly here in the first quarter so far of 2017, we're seeing that play out pretty much as expected. So on an annual average basis, 2017 is kind of a sideways year. We will see probably more typical seasonality. So you think about calf prices, they're typically seasonally low in the fall of the year. So we probably will see some seasonal weakness in the fourth quarter for these calf prices. And again, kind of the normal seasonality. The market's really not trending anywhere, so you would expect to see the normal seasonality kind of express itself fairly typically in that environment. One thing that has changed in just the last few weeks that I wanted to mention, it's very important in Oklahoma and surrounding areas. There's a lot of numbers on here, and I apologize for that, but basically this shows you several examples of stocker margins. So let's use as an example here, if we start with this 500-pound calf in the middle of this table at last week's prices in Oklahoma. So this was the average price over here. If you bought that calf, and then we're looking at one point in time, so we're buying and selling on the same market, which is not reality, but it tells you what the price relationships are. So if you take that 500-pound calf and you start putting weight on it, the yellow box down here is 250 pounds of gain, which is kind of a typical stocker-based program. And what this is telling you is that the value of those 250 pounds in today's market has dropped pretty dramatically in the last few weeks, down to about 60 cents. Long term, we expect these values of gain to reflect what the feedlot cost of gain is. And we talked about cheap feed, which certainly helps feedlots in particular when you talk about cheap corn. What we're seeing now is this market for the first time in many months is actually reflecting that cheap grain in the feeder cattle markets. And it means that those margins for feeder cattle or for stocker cattle gains have dropped dramatically, and that means our stocker producers really need to pencil out carefully what their potential is. If you're grazing out calves, and certainly there's much less incentive to take these calves to bigger weights. So if you take this 500-pound calf it stays about the same. It's pretty stable, but there's, again, 60-cent value of gain doesn't give you much margin to actually pay the feed cost to put that weight on and have anything left over from a profit standpoint. And that's all we're looking at here. This value of gain is basically the gross margin that you start with before you pay any of the bills. So, and if you compare this, let me show you a chart from just a few weeks ago. In the third week of January, these numbers were significantly higher. They were in the 80 to 85 cent range, and even higher for the high-end weights. And so the market has shifted dramatically. Feedlots can do it cheaper, and that's being reflected now in the feeder cattle market in terms of the price incentives that are out there for stocker producers to do what they do, and they have to figure out how they're going to respond to that. That's a little longer than I meant to go. I apologize. Let me stop there and see if anybody has any questions. I think I'm done at that point. I've got just my contact information on here if you're interested in getting a hold of me, or if you are interested in a weekly newsletter that Glenn Selk and I write, you can let me know, and I'd be happy to send that to you. Let me stop there, Brent, and see if anybody has any questions, and then I'll let you take it back from there.
Great. Thank you, Dr. Peel. As a reminder, if you have any questions for Dr. Peel, enter them in the chat box down in the lower right-hand corner.
Looks like we have some typing going on, so we'll wait for a question here.
I'm also going to post a link to the farm management course that I mentioned earlier, as well as a survey link. We appreciate feedback on this webinar, so if you could fill that out, that would help us.
Brent, is this your question? The recent increase in, and I assume you mean price of 500-pound cattle, has been pretty dramatic. Is it sustainable or a little bubble? Relative to the increase we've seen, and you can tell me if I'm interpreting your question wrong here, but relative to the increase we've seen since last October, where we went through that really awful low that I thought was way overdone then, and I think time has sort of proven that to be the case. So I'm going to argue that I think it is pretty sustainable. Now, we could be overdoing it a little bit here for a spring peak in the short run, but most of that increase from last fall, I think, was correcting something that went too far going down. Again, there was a bit of transition last year as the market really got used to the idea that we can still we can still see some profitability. We can still go along with increased beef production, and so I do think the majority of it is sustainable. Now, that said, it's still running strong, and we could overdo it a bit this spring from a seasonal standpoint. But I really think, again, more stable. I'm comfortable in general with the levels we're at. I'm comfortable with the margins that we see between these prices. Feedlots are actually making some money right now. They haven't made much money in recent years, and so that's something that's sustainable. At some point, they do have to be able to make a little money. The strength in boxed beef right now lets packers make a little bit of money. And again, this prices can work maybe with a little more management challenge at the cow-calf level. So the stocker sector, as I just described, may be getting squeezed a bit, but in general, this is the kind of market that can be sustainable and sort of works. There's no real reason why things need to adjust unless something new comes along that we don't see today.
Did you see the follow-up to that question, Dr. Peel, that they were referring to the spring peak?
Yeah, so, again, it's not uncommon that we would see kind of a spring seasonal peak here. So, we very likely will see some movement off of that spring peak that's just seasonal. It happens most every year. We expect to see that here in the next 2-3 weeks. In many cases, for the lightweight calves, for the bigger feeder cattle, actually they stay pretty strong through the first half of the year and then weaken a bit into the third quarter, perhaps. But so I would expect to see the seasonal patterns that we kind of know are out there, but nothing more exaggerated than that at this point in time.
Thank you, Dr. Peel. It looks like a couple more people are typing, and then we'll wrap it up.
One asks, what other major cow states may still be expanding the herd? That's a really interesting question. If you look at where most of the reduction from the drought happened, it was in the southern plains. As I showed you, Oklahoma has more than recovered from the drought levels. We're actually slightly above where we were going into the drought. Texas, on the other hand, which is, of course, the biggest beef cow state, has not recovered nearly as dramatically. They didn't start recovery as quick as Oklahoma did. And relative to pre-drought levels, Texas is still probably 600,000 to 700,000 head short of those pre-drought levels. Now, there's a very real question of whether we would expect all of that to be recovered. There may be some other things have changed, but certainly I would think there's potential for a significant amount of the remaining expansion to happen still in Texas. If you look in the Midwest and some other places, of course, they didn't see as much loss during the drought, and there's a little less incentive or expectation that we will see that. So it can really surprise you because you don't always know who's responding to the price signals. But when you just look physically at where the cattle were lost and where their numbers are still down, you'd have to think that perhaps Texas is more likely to see some growth than some other areas. But it changes a lot. There's a lot of difference in the situation right now between Texas and Oklahoma. New Mexico also expanded pretty dramatically last year. And I can't remember where they are relative to pre-drought levels off the top of my head, but I think, again, they've probably have less potential to see a lot more expansion. So we'll see.
And one more question, it looks like.
What impacts on replacement cattle prices do you see happening locally due to the fires out west? I don't know that I expect to see. Well, of course, we don't really know what all was lost. So we really don't know the situation. We don't even know the total sort of head count or casualty count, if you will, in terms of losses due to the fires. We don't know how that breaks down between calves and cows and yearlings or stockers. I guess I would be very surprised in general if we see much impact. To be honest, I doubt that we'll be able to detect it. As devastating as these things are for the people involved in them, it really is not likely to show. I think it's pretty unlikely to show much of a regional impact in terms of that. Now, to the extent that there were females lost, and it is still spring of the year, assuming, again, that we get the normal rains, most of this range country will recover very quickly and will be in very good shape, actually, after the burn. A lot of it would benefit from burning more regularly, but that's always a challenge for us. So the recovery could be pretty dramatic, and that could lead to some additional demand for replacements. But again, I think the numbers are such that we will be very unlikely to be able to see that as we go forward. Again, it's as devastating as it is on a local scale. It's really not big enough to be much of a market impact. What do you see killer cow prices doing going forward? They have recovered a little bit from, again, the lows last fall, but we're in a bigger herd situation. We're going to have more cows that are normally going to be culled as we go forward. So we get into this fall, we see our seasonal lows. These cull cow prices are going to be relatively more abundant. There'll be more cows. That said, most of what impacts the killer cow market is, or the slaughter cow market is, the cull cow market is the ground beef market, and that has big implications relative to those beef imports. So I really look for the slaughter cow side of this thing to stay pretty steady. There will be a bigger supply of them, and so there's some risk there that we could see a little more supply pressure. But at the same time, we're seeing less beef imports, and that's really the major trade-off there in terms of the product that goes into the ground beef market. So I don't look for a lot of additional pressure there other than the normal seasonal lows, which are pretty dramatic for cull cows in the fourth quarter of the year.
Thank you, Dr. Peel. Thank you, everyone, for joining us today. As a reminder, we do have the survey link over in the chat box if you'd fill that out to give us feedback if you enjoyed this webinar. And thanks again, and have a nice day.